commodities. Again, it's a risk on, risk off speculative endeavour. I've drawn these three rectangle bases here on the weekly chart for you to see, and they correspond quite closely with new liquidity coming into the market. So back in early 2009 we had a base here, then we jumped out, we had another one here before QE2, and then there was a massive rally. And then we started to correct, and we've just bottomed here around about the 300 point. Now in recent weeks, and I noted this on trading week, this structure here to me looked like a short-term tactical trade, and I'll go to the daily charts and zoom out, and you can see what I mean here. We had a left-hand shoulder here, we've had a head pattern here, well, that's called a bull trap, where the market goes above a bullish indicator and then comes back down. And then we've had the right hand shoulder here, and this neckline here at 311 points has been broken, and we've corrected about 3 or 4% ever since. Now this recent weakness has been mainly because of soft commodities, not the base metals and crude. So we're going to look at that now, and I always look at ICE Brent crude. I used to follow West Texas, but I find it to be not as indicative. So let's have a look at the long-term charts. What I've actually done here is overlaid Brent with West Texas, which is the green line you can see here, just to give you an indication of how they follow each other most of the time, and the massive volatility that oil prices have in the markets, which is mainly the cause of central bank liquidity, but also speculators, because it's a very easy currency to speculate in, commodity to speculate in. Right, let's look at the shorter term. We had a divergence in West Texas back in the correction last year, but you can see the blue, the crude ICE Brent, stayed quite strong. The reason for that is the European, we had a bit of panic buying in the UK, and probably an expectation that oil prices are going to stay fairly high. We also had a lot of supply issues in the Middle East and so forth. Technically though, the picture I want to look at is this line here at $125 a barrel. It's a resistance level, which means I call this a foot on top of the market. So you've got a foot here pressing the prices down. We hit that in April last year, and we hit it again in March, and we've corrected down below 120. I'm just going to go to the daily charts to show you what's happened recently. And I did warn about this in my last couple of trading week posts. We had a rectangle pattern here where we had prices oscillating between 123 and 126, and I warned that if it broke below 123 we'd see a sharp sell-off, and that's what's happened. However, there's still a bullish bias to this. We've got the 200-day moving average here. We've got a lot of commentators and the consensus crowd out there saying that the economy is pretty good, so therefore prices should stay quite high for oil. So that's one to watch. So going from oil, we have to go to the S&P. Now the S&P 500 US market, I'll just zoom out again. I always like to start on the monthly or even quarterly charts. Quarterly charts are actually very interesting. I'm going to go to a very long-term chart here just to explain to you what a secular bear market looks like. Now the US market had been in a secular bull market from 1981 through to its top here in 2000, and this last move was the tech stock bubble on the NASDAQ, which followed everything else. And then it crashed and corrected down to the 02, 03 level. Had a cyclical bull market up to 07. We had the Great Recession, which is what it's called overseas, and we crashed down in 09, and now we've had another cyclical bull market. Now this is something very important to understand, because this whole structure of the last 12 years has been a secular bear market, which means high volatility, a wide trading band, and something that you can still position yourself in, but is also very risky. So let's just go to a weekly chart and I'll explain what's going on. I'm just going to zoom in a little bit here. And I'll turn there's a lot of lines here, apologise, but we have to look at this market closely, because from here you get the signals for the local market. Again, let's have a look quickly. We're back here in August, September 2010, where the punch bowl of liquidity was taken away from QE1. So we had QE2, jumping above this level of resistance here, and we're off to the races. So the market quickly went up almost 20%, and then we had another top here. I won't show you, but there was a pattern there that came out that was very crystal clear, and a lot of traders like myself, we took advantage of that pattern when it broke down back in August in 2011. So we broke down and we had this huge range of volatility here, and those of you who remember the August to Christmas period, for trading day followers, that was a really turbulent time. We had a lot of bulls and bears saying, you know, it's the end of the world, it's the start of a new rally, it's the end of the world, it's the start of a new rally. I wasn't long through this period on a position basis because my trading system basically said, stay the heck out of there. So we then had a breakout, and we've broken out to new highs, and we've actually beaten the high from the previous correction high in April over here. So we're now above, went above 1400 points, and we've had a dip. Now, as remember, on the VIX, the volatility index shows that this is most likely a dip and not a correction. A correction would mean back down here to 1250 or so on the S&P. So things are looking okay so far, if a little bit weak. The macro data is starting to slip for the US, but the consensus crowd is still quite bullish. So my long-term view on the S&P is, if you follow this regression line, is they're likely to go to 1550. As incredulous as that sounds, probably will take QE3 for them to do that, but that's the pattern that usually follows in secular bear markets, unless something comes out of left field, of course. So let's finish off with the ASX 200. I always analyse everything else before I get to this because the Aussie market follows every other market in the world. It's fairly silly to just look at the Aussie market in isolation. Again, quick history lesson. We had a bear market in 01 to 03. We got out of that funk. We beat that level. And we just went too far, too fast, too quickly following China. And that was a definite stock market bubble from 04, 03 to 07. And we crashed, went down 52% from memory. And I'll just zoom in a little bit more to give you an understanding of what's happened since then. And then we had a 60% rally. Something to work out, 50% down, 60% up. How come we're only here? Well, ask the property guys if they can understand percentage changes, how important they are on the upside and the downside. The Aussie markets followed a textbook classic secular bear market. We've had with one minor change, because of all the capital raisings that were done in 09, what's happened is most of the industrial stocks on the ASX have actually repaired their balance sheets, which means they've paid off all the debt they accrued in the 03 to 07 bubble, and they're down to about 30% net debt to equity. What that means is, going forward, the return on equity they can get on that money is limited to what they saved on that debt, which is about 6%. So the average return on equity for most industrials is about between 11 and 15%. So that's been permanently cut off, and that's why you see that earnings capacity is actually lower than what it was previously. So don't expect that this structure, this 5,000 to 7,000, to come back anytime soon. It's because our corporates indulged in too much debt that it's been pushed down so much. Anyway, going back to the technical picture, what we've got here is we've had a rally, we've had a correction following everybody else, and we've had a very significant correction down to 4,000, where we had what's called a double bottom pattern here around the 4,000 mark. Let's have a quick look at that before we go on. And I'll just get rid of that line. Again, we had a battle between the bulls and the bears, and the bulls look like they're winning. We're winning quite well here. We've had a series of higher lows along the way here, and we've had a breakout just recently where the market's gone above 43.50, and it looks like zooming ahead. If we go down to the daily chart, you can see that quite clearly. Above 43.50, we've picked up. I'll just zoom out a bit more here, and you can tell we're above the 200-day moving average. So the bias has definitely moved to the bullish side. And for the time being, if the RBA eases rates, we're probably going to look to a 4,500, 4,600 rally in the weeks ahead. So thanks for listening, and I'll get back to you next week.